Ever wondered why companies buy back their own shares and what it means for your portfolio? Stick around, because by the end of this video, you'll have a clear understanding of what stock buybacks are, why they happen, and how they affect both companies and investors like you. But before we get started, if you're new here, make sure to hit that subscribe button and ring the bell to get notified whenever we drop new content on finance, investing, and more. What is a stock buyback? First things first, what exactly is a stock buyback? A stock buyback, also known as a share repurchase, is when a company buys back its own shares from the open market. This reduces the number of outstanding shares, meaning each remaining share represents a larger ownership stake in the company. It's a way for companies to return cash to shareholders, often seen as an alternative to paying dividends. Imagine a pie that's been divided into 10 pieces. If 2 of those pieces are bought back and taken out of the equation, the remaining 8 pieces are now each slightly bigger. That's essentially what happens with stock buybacks. Each share left in circulation becomes more valuable, at least theoretically. Data from the Federal Reserve shows that between 2010 and 2020, U.S. companies repurchased over $6 trillion worth of their own shares. This trend has been driven by companies across various industries, from tech giants like Apple and Microsoft to consumer goods companies like Procter & Gamble. Now, why would a company decide to spend its hard-earned cash buying back its own shares? There are several reasons, and they can vary depending on the company's situation. One of the most common reasons is to boost the stock price. When a company buys back shares, it reduces the supply of its stock on the market. If demand remains constant or increases, basic economics tells us that the price is likely to go up. This can be particularly attractive to shareholders and company executives who hold stock options. Take, for example, the buyback program announced by Apple in 2013. At the time, Apple committed to returning $100 billion to shareholders through buybacks and dividends. The result? Apple's stock price saw significant appreciation, rising from around $60 per share in 2013 to over $300 per share by early 2020, contributing to its trillion-dollar market cap milestone. Stock buybacks can also improve key financial ratios, such as earnings per share, EPS. Since EPS is calculated by dividing net income by the number of outstanding shares, reducing the share count through buybacks can lead to a higher EPS, making the company appear more profitable. For instance, let's say a company has a net income of $1 billion and 500 million shares outstanding, resulting in an EPS of $2. If the company buys back 50 million shares, reducing the share count to 450 million, the EPS would increase to approximately $2.22, even if the net income remains unchanged. Microsoft's aggressive buyback strategy over the past decade is a perfect example. Between 2010 and 2020, Microsoft repurchased over $100 billion of its shares, significantly boosting its EPS and contributing to its impressive stock performance. Another reason for buybacks is to return excess cash to shareholders. If a company has more cash than it needs for its operations or growth, it might decide that buying back shares is a more efficient way to return value to shareholders than paying a dividend. For example, Berkshire Hathaway, led by Warren Buffett, has historically favored buybacks over dividends when the company has excess cash and no immediate need for it. This strategy allows the company to reward long-term shareholders without committing to a regular dividend payment, giving it more financial flexibility. Berkshire Hathaway's approach is often seen as the gold standard in using buybacks responsibly. Buffett has repeatedly stated that buybacks should only be done when a company's stock is trading below its intrinsic value, ensuring that the buybacks truly add value to shareholders. Let's take a closer look at how a stock buyback actually works. There are generally 2 methods: open market repurchases and tender offers. In an open market repurchase, the company buys back its shares just like any other investor through the stock market. These repurchases are typically spread out over time to avoid causing too much volatility in the stock price. Open market repurchases are the most common method, used by companies like Apple, Microsoft, and Johnson & Johnson. These buybacks are often executed over a period of time to minimize the impact on the stock price, allowing companies to buy back shares at a favorable average price. On the other hand, a tender offer involves the company making a direct offer to shareholders to buy back a specific number of shares at a fixed price, often at a premium to the current market price. Shareholders can choose to sell their shares back to the company or keep them. A famous example of a tender offer occurred in 2018 when General Electric, GE, launched a $23 billion tender offer to buy back shares at a premium price. This move was part of GE's broader strategy to reduce its share count and improve its financial metrics during a challenging period for the company. While the tender offer helped stabilize GE's stock in the short term, the company's ongoing challenges highlighted the risks of relying too heavily on buybacks during periods of financial stress. While stock buybacks might sound like a win-win, they're not without controversy. Critics argue that buybacks can be a way for companies to artificially inflate their stock prices, often to the benefit of executives whose compensation is tied to stock performance. One of the main criticisms is that buybacks can divert funds from more productive uses, like investing in new projects, research and development, or even employee wages. When a company prioritizes buybacks over these investments, it might boost short-term stock prices but could harm long-term growth. For instance, during the 2000s, many major airlines spent billions on stock buybacks while cutting back on investments in infrastructure and employee benefits. This strategy backfired during the COVID-19 pandemic, when these airlines struggled to survive without government bailouts, revealing the long-term risks of excessive buybacks. On the flip side, proponents argue that buybacks are a legitimate way to return excess cash to shareholders. If a company doesn't have profitable investment opportunities, buybacks can be a way to return value to shareholders without committing to a regular dividend. Take tech companies like Alphabet, Google, and Facebook, now Meta, which have used buybacks to efficiently return capital to shareholders while continuing to invest in innovation and growth. These companies argue that buybacks offer flexibility in managing their capital, allowing them to adapt to changing market conditions. Stock buybacks can also have a significant impact on financial measures beyond just the stock price. As we mentioned earlier, buybacks can boost EPS, which can make a company look more profitable. However, it's important to note that this doesn't necessarily reflect an improvement in the company's actual business performance, just a reduction in the number of shares. For example, IBM has been criticized for relying heavily on buybacks to boost its EPS over the past decade. While the company's EPS has increased, its overall revenue growth has been flat, raising concerns about the sustainability of its business model. Some of the world's largest companies are frequent users of stock buybacks. For instance, Apple has been one of the most prolific in repurchasing its shares, spending hundreds of billions of dollars on buybacks over the past decade. Microsoft and Berkshire Hathaway are also notable examples of companies that have used buybacks as part of their strategy. Apple's buyback strategy has been praised for its effectiveness in returning value to shareholders. The company's consistent buybacks have helped boost its stock price, benefiting long-term investors. In fact, Apple's buybacks have been so significant that they've reduced the company's share count by over 30% since 2012. This reduction has not only boosted EPS but has also contributed to Apple's stock being one of the best performing in the S&P 500 during this period. Berkshire Hathaway, under the leadership of Warren Buffett, has taken a more conservative approach. Buffett has stated that buybacks are only justified when a company's stock is trading below its intrinsic value. This disciplined approach ensures that buybacks truly add value to shareholders. In 2020, Berkshire Hathaway repurchased a record $25 billion worth of its shares, a move Buffett described as good for shareholders given the stock's attractive valuation at the time. This approach contrasts with companies that engage in buybacks regardless of market conditions, which can lead to suboptimal outcomes for shareholders. So, what does all of this mean for the long term? The impact of stock buybacks can vary depending on the company and market conditions. In the short term, buybacks often lead to a boost in stock prices. However, if a company overuses buybacks, it could potentially harm its long-term prospects by underinvesting in its business. Market conditions play a significant role in determining the effectiveness of buybacks. In a bull market, buybacks can amplify stock gains, but in a bear market, the impact may be less pronounced. Additionally, companies that repurchase shares at inflated prices risk destroying shareholder value if the stock price declines later. For instance, during the 2008 financial crisis, many companies that had aggressively bought back shares in the years leading up to the downturn found themselves in a difficult position. Their stock prices plummeted, and they were left with fewer resources to weather the storm. On the other hand, companies that held off on buybacks during this period were better positioned to recover and grow in the following years. Regulatory changes and economic conditions can also influence the use of buybacks. For example, in some countries, there have been calls to restrict buybacks, arguing that they contribute to income inequality and short-termism in corporate governance. In the U.S., the debate over buybacks has intensified in recent years, with some lawmakers proposing limits on buybacks or tying them to conditions such as higher minimum wages for employees. In 2020, the CARES Act temporarily restricted buybacks for companies receiving federal aid during the COVID-19 pandemic, highlighting the potential for future regulatory changes. Meanwhile, other countries have taken different approaches. For example, in Japan, stock buybacks have become more popular as corporate governance reforms encourage companies to return excess cash to shareholders. However, in countries like Germany, buybacks are less common due to cultural and regulatory differences, illustrating the diverse perspectives on this practice globally. And there you have it. A comprehensive look at stock buybacks, how they work, and their impact on the market and your investments. Whether you view buybacks as a smart way to return value to shareholders or a potential risk to long-term growth, understanding this financial tool is key to making informed investment decisions.